You want to know what Bitcoin is in simple terms? Well, let's dive right in. Bitcoin is a form of digital or virtual money. Unlike the dollar bills in your wallet or coins in your piggy bank, Bitcoin doesn't exist in a physical form. It's a type of cryptocurrency, a modern marvel of financial technology. Bitcoin made its grand entry onto the world stage in 2009. But who brought this digital currency into existence? The answer is shrouded in mystery. An unknown person, or perhaps a group of people, using the pseudonym Satoshi Nakamoto, introduced Bitcoin to the world. Despite numerous attempts to unveil the true identity of this enigmatic creator, Satoshi Nakamoto remains an elusive figure. Now let's talk about the platform where Bitcoin operates. It's called the blockchain. Imagine a massive ledger, visible to everyone, that records every single Bitcoin transaction. That's what the blockchain does. It verifies and records every transaction, providing a transparent and secure system for Bitcoin operations. But how does it do that? It's the miners who make it happen. We will know more about miners in very soon. Bitcoin is also unique in its divisibility. One Bitcoin can be divided into 100 million smaller units called Satoshis, named after the mysterious creator. So, Bitcoin is a digital currency that operates on a secure and decentralized system known as the blockchain. It's a fascinating blend of technology and finance, an innovation that's revolutionized the way we think about money. Now that we know what Bitcoin is, let's delve into how it actually works. Think of Bitcoin as a digital currency that you can send or receive across the globe. But instead of being stored in a physical wallet or bank, it resides in a digital wallet. Here's where it gets interesting. When you send Bitcoin, you're not sending a physical object or even a digital file. Instead, you're broadcasting a message to the whole Bitcoin network that you're transferring ownership of your Bitcoin to someone else's digital wallet. But how does the network verify this transaction? Enter the miners. Miners are individuals or groups with high-powered computers who validate and timestamp transactions, adding them to a public ledger known as a blockchain. They do this by solving complex mathematical problems. Once a problem is solved, the transaction is verified and added to the blockchain. This process ensures that the same Bitcoin can't be spent twice, creating a secure and transparent system. Now let's talk about the smallest unit of Bitcoin, called a Satoshi. A single Bitcoin can be divided into 100 million Satoshis. This divisibility makes Bitcoin adaptable to all types of values, from the minuscule to the massive. So, there you have it. Bitcoin operates on a decentralized network, where transactions are made from one digital wallet to another, and verified by miners who solve complex mathematical problems. Each transaction is then added to the blockchain, a public ledger, ensuring transparency and security. You might be wondering, how do you get your hands on Bitcoin? Well, there are two main ways to acquire Bitcoin: buying it on a cryptocurrency exchange or mining it. Let's break these down, starting with buying Bitcoin. There are numerous cryptocurrency exchanges available online. These platforms allow you to purchase Bitcoin using traditional money, also known as fiat currency. This could be dollars, euros, yen, or rupees, you name it. Once you've set up an account on an exchange, you can buy Bitcoin at the current market price. Just like buying stocks or commodities, you can hold on to your Bitcoin and sell it later, hopefully when the price has increased. Now, let's talk about the second way to acquire Bitcoin, which is a bit more complex: mining. Bitcoin mining involves using computers to solve complex mathematical problems. Whenever a problem is solved, a new block is added to the Bitcoin blockchain, and the miner is rewarded with a certain amount of Bitcoin. This is essentially how new Bitcoin is created. But here's the thing: mining isn't for everyone. It requires considerable resources, including powerful hardware and a lot of electricity. Plus, the mathematical problems involved are not your average high school math problems. They're incredibly complex, and solving them requires a significant amount of computational power. In addition to individual mining, there are also mining pools. These are groups of miners who combine their computing power to solve the mathematical problems more quickly. The Bitcoin reward is then split among the members of the pool. One important thing to understand about Bitcoin is its volatility. This is a key feature of Bitcoin that sets it apart from traditional stable currencies like the dollar, euro, or yen. The value of Bitcoin can fluctuate wildly in short periods of time. Some days, the price might remain relatively stable, while on others it might soar or plummet dramatically. This volatility is due, in part, to the fact that Bitcoin is a relatively new market. It's still finding its footing in the world of finance, and that uncertainty can lead to significant price swings. Another factor is that Bitcoin's price is heavily influenced by market sentiment. News about regulatory changes, technological advancements, or economic events can cause rapid increases or decreases in value. Now, you might be wondering, is this volatility a good thing or a bad thing? Well, that depends on your perspective. For traders and investors who thrive on risk and uncertainty, Bitcoin's volatility can present exciting opportunities. When the price of Bitcoin rises rapidly, those who bought in at a lower price can sell their holdings for a significant profit. It's a bit like riding a roller coaster, thrilling for some, terrifying for others. Those who bought Bitcoin at a high price might find themselves in a tough spot if the value drops. The key is to carefully consider your own risk tolerance and financial situation before jumping into the world of Bitcoin. Because remember, as much as we'd all like to strike it rich, it's equally important to avoid losing our shirts in the process. Finally, let's talk about how you can trade Bitcoin. Like we said before, Bitcoin can be bought and sold on various platforms known as cryptocurrency exchanges. Trading Bitcoin involves buying it when the price is low and selling it when the price is high, similar to the stock market. This requires a keen understanding of the market and the ability to predict future price movements. However, unlike traditional stock markets, cryptocurrency markets operate 24 hours a day, 7 days a week, meaning the Bitcoin price can change at any moment. Now, if you're looking for a more advanced way to trade Bitcoin, you might consider Bitcoin derivatives. These are financial products that derive their value from the price of Bitcoin. They allow traders to speculate on future price movements without owning the actual Bitcoin. These derivatives can take several forms, including futures, options, and contracts for difference, each with their own set of risks and rewards. Whether you choose to trade Bitcoin directly or through derivatives, it's essential to remember that while these strategies can be profitable, they also come with a high level of risk due to Bitcoin's price volatility. The price of Bitcoin can fluctuate wildly in short periods of time, which can lead to significant gains or losses. It's also important to note that while trading Bitcoin can seem exciting, it requires a lot of knowledge, preparation, and a clear understanding of the risks involved. As a rule of thumb, only invest money that you can afford to lose. We hope this video provided a value to you. If it did, please smash the like button and hit the subscribe for more such good content.